Hello, crazy day on Wall Street, but I guess if you've been following my tweets and listening to my radio programs lately, you weren't probably too surprised by some of the things that took place today in terms of price movement. As we talk all the time, the surface price of a thing, in this case the equity market, is always the last to give. The things underneath it that start to accumulate, specifically volatility and volume, are what give you the clues as to what's taking place. In terms of global macro, the most important thing that we could have been paying attention to, and we're paying attention to, can still pay attention to, is the U.S. dollar. Lots of negative correlations still exist with asset classes across the globe and the U.S. dollar in terms of the S&P, Brent oil, CRB index, and gold. All those still negatively correlated, much more heavily on a 30 to 90 day basis versus a 15-day basis, but still pretty negatively correlated. Meaning, when the dollar goes up, the other asset classes in those items that I just mentioned go down. So about 2 days ago, we hit an intermediate term trade oversold level in the dollar and expected a bounce. You might have noticed I lightened up the load on a lot of the different asset classes within commodities and rates and things of that nature. And then, of course, today we were very heavily positioned in different forms of bonds, commodities that, again, did fairly well, but I lightened the load on a lot of those over the last couple of days, so today was a day to buy more. So what did we do today? We took advantage of interest rates dropping towards the low end of the mathematical range. We took advantage of the various commodity structure and commodity complex all hitting their low ends of the range, all as a function of the dollar hitting the top end of its range, all viewed through the lens of volatility in the equity market kind of going nuts. So I'm going to share just a few quick screens with you to give you a glimpse into some of the thought patterns that take place. Certainly in terms of equities in the equity space, it was a terrible day for holders of general U.S. equities. The Nasdaq was down almost 5%. The S&P was down a little over 3.5%. And I think on balance, the majority of our portfolios were off anywhere from 1/10 to less than 0.5%. And I think those will move themselves higher fairly quickly once the commodity complex kicks back in gear, which after hours appears like it's happening already, because it looks like the dollar bounce might be over. Might be a little bit more upside in the dollar, but it appears to have waned itself and worked itself out. So let me share my screens real quick and give you a couple of quick perspectives. So as I said, here's the Nasdaq down about 4%, and one of the reasons why that happened was the volatility complex, which is this, having been moving. So we talk about episodic and trending, or episodic and clustering in terms of volatility. This is episodic and trending, and it had been trending higher, broke trend of 30, as I've commented on my radio show and tweets and things of that nature. And as you can see, it continued to move higher. And when you get volatility moving higher through the lens of price continuing to move higher, this sort of thing becomes fairly common. And so it's this sort of thing that we want to try and avoid as much as we can when we see volatility doing a trend above what the trend resistance level would be. Trend resistance level for us would have been about that 30 level for the Nasdaq. And so that's one of the reasons why we have not had or allowed really much of any tech exposure. Now, there will be some opportunities to buy tech, and I think that is definitely something that we'll want to look at, because as I've mentioned before, technology, utilities, real estate, commodities, emerging markets, those are all assets that we want to own in the context of a quad 3 type of a stagflationary economic environment, which we still believe to be in. The emerging market stuff that we're buying is all in quad 1 or quad 2. Quad 1 is growth with decelerating inflation. Quad 2 is growth with increasing inflation, both of which are really good for growth type asset classes. We're not there yet. We're still within the lens of stagflation, and we know that just because of what's happening with interest rates, real rates, in other words, nominal rates minus inflation, which are currently negative, And it just doesn't appear that interest rates want to, at this point, break out above the trend level that we've been showing you. So let me share that next. The 10-year Treasury rate, a few days ago, I commented on how it was bumping up against trend, and that according to the previous times that happened, just wouldn't be surprised for it to be a head fake. Well, it was. And bonds got up to 0.75%, 0.747% back here on August the 27th. This is a time where we really loaded up on our 10-year treasuries and extended treasuries, which are expressed through the exchange-traded funds EDF and TLT. And so we loaded up here. And when you load up on bonds with interest rates being high, you're buying them at a low price. And then look what happened to interest rates after this trend was a head fake breakout. They dropped, and they dropped pretty heavily. Low end of the expected mathematical range of interest rates today was 0.6%. We hit 0.606%. And so therefore, in the lens of price movement today, we unwound a fairly large portion of our extended duration treasuries and our long-term treasuries, again expressed in the exchange-traded fund TLT. And by doing that, we're just capturing some gains that have taken place within the lens of those bonds over the last 4, 5, and 6 days. Some of the other things that we've been doing today, we're using those proceeds and buying some of the commodities that went down over the last few days when the dollar value went up. And so as the dollar value goes up, those commodity complexes come down. When the commodity complexes come down, we buy those. So like we talked before, it's plant, it's prune, it's repeat. So the last few days we've been pruning in the commodity complex, and we planted in bonds. Today we pruned bonds and planted back into commodities, and also some of the emerging market space. China was on sale, so we bought some exposure to China. Indonesia was on sale, so we bought exposure to Indonesia. Finland and Norway were also both on sale, so we bought exposure to both of those countries. And last but not least, one of the things that we'd been waiting on was to increase our exposure to the oil complex. And when we increase our exposure to the oil complex, we can do that in a couple of different ways. For our more aggressive accounts, we'll use a little bit of leverage. For just very normal, non-levered type portfolios, we'll express that with the exchange-traded fund BNO, which is focused on Brent crude. Just like the complex of that, a little bit better than USO or some of the other ones that are out there. But another way to express that in the emerging market complex is to buy Russia. So we increased our exposure to Russia because, again, oil was the first commodity essentially to hit the low end of the mathematical range and expected movement for the commodity complex. So again, it's pruning on the bond side, buying on the commodity complex side. And so I'll share with you a few quick screens to see what that looks like. So interest rates spiked here real quick. We were buying bonds in this area. And then, of course, interest rates dropped, and it caused the bond complex to increase in price. So we unwound our bonds down to a fairly nominal amount, about 3% long-term treasuries, about 0.5% in extended duration treasuries, which is this one. And then we used those proceeds over the last few days to buy the protein complex. We also, as I pointed, bought oil. We bought Russia. And again, we're buying these things on sale down in these levels. We bought Norway down in this level. We bought Finland. We bought exposure to China. We bought exposure to Indonesia. I was selling Indonesia up here. We bought it back here. Various prices throughout the day, just as things were working. We also bought exposure to something that is a little bit different, but we bought exposure to Bitcoin. For those of you that don't know what Bitcoin is, it's the digital cryptocurrency, and it's very sensitive to the movement of the dollar. When the dollar moves up, the Bitcoin moves down fairly heavily. When that changes, Bitcoin moves up very, very quickly. So it's something that we don't intend to hold on to for a long time. It's not the Bitcoin where you actually own the digital cryptocurrency that you can put into a cold storage wallet or anything like that. E-Trade won't allow us to hold those particular kinds of pieces of crypto. But I believe in that particular form of technology. I think it has a place. I buy some for my own personal account. I also own GBTC along with the rest of you. So this is just simply an exchange traded fund that allows us to express the ownership of Bitcoin, and we do that simply because the mathematical model said it was time to buy some. So we did. We increased our exposure to that just again as a function of what we saw happening within the lens of the dollar and within the lens of volatility of that structure as well. So any rate, markets in terms of U.S. equity was not great, and most of the reason why it was not great was because of volatility. And so again, you hear me talk an awful lot about VIX. This is what happened to VIX today. It was trending, episodic and trending, and it broke above 26 and stayed there for the last 3 days. 26 was trend level, and then all of a sudden we had this cluster, kaboom. And when you get VIX popping up into this neck of the woods, and it was trending above and maintaining above 26, I've said lots and lots of times that bull markets just don't typically sustain themselves with VIX north of a certain level. That level was trend, which was 26. Now it could change. We're probably going to get a lot of backing and filling and all sorts of volatility within the general equity space. I'm not interested in participating in that. I want to minimize volatility while at the same time taking advantage of bull markets that exist across the globe within all sorts of different asset classes. And that's the nice thing about being focused on global macro. We'll buy anything anywhere at any time as long as it's in a bull market. And so those things continue to be, as I've pointed out, gold, rates, commodities, exchange, emerging markets, things of that nature. A couple of days ago, we increased our exposure a considerable amount to utilities. Down in this realm, utilities popped yesterday and then also this morning. So I sold a lot of utilities here and then a little bit more there. Same thing was true with real estate. Real estate popped. I sold a little bit here. And, we've very little exposure, about 1.74%, 1.75% in utilities, about 2% in real estate. And also we brought down our gold exposure when it was up in this neck of the woods. So I think we were selling gold about 186, 187. And now that's started to come down. If I see GLD, which is the exchange traded fund for gold, get down around the 180, 179 range, I'd probably load up on it again. Because again, in quad 3 with stagflation, that's what works. So at any rate, that's where we're at. That's what's going on. Wanted to let you know real quickly that you did not participate to the extent that you're likely seeing on the news, or anywhere near to the extent that the macro tourists, as we call them, who get their driving instructions from the mainstream financial press or things of that nature. That's not how your portfolios are set up. So we do things very, very differently, as you know, and we continue to operate, manage around the global macro picture. We'll continue to do so through the lens of volatility as best as humanly able. By way of continuing to plant, prune, and repeat. So, at any rate, if you have any questions, let me know. Just continuing down that road as best as possible, and looking to take advantage of opportunities along the way. Into the close today, I think we were hovering right around 30% cash, approximately 22% in the commodity complex, and approximately 25% in the various forms of the bond complex through Treasury inflation protected securities, long-term treasuries, extended duration treasuries, and short-term treasuries. Short-term treasuries are boring, but they're very safe as well. So that's it. So if you have any questions, give me a call, 608-354-1977, or shoot me an email, chris@careformywealth.com. Again, No such thing as a silly question. Always look forward to hearing from you and always thankful to work for you. Thank you so much. Have a great night. See you.